Welcome back to the Investonomics channel, everybody. This week we're doing a trading video for the first of the trading series. And this week we're going to be covering stock exchanges. And I'll do a bunch of these little videos on the stock market and just giving you some overview and basic concepts. So I'll see you guys next week. Today's topic is the first of the trading series on stock exchanges. So here we can see a photo of probably the most iconic stock exchange in the world, which is the New York Stock Exchange, the NYSE, which is in New York City in the United States. So a stock exchange functions as a market mechanism for the stock market, and it serves as an intermediary. So in the simplest terms, it is where stockbrokers, traders, investors, and retail traders, which is traders like you and me at home, meet to buy or sell securities such as stocks, bonds, options, and futures, which are derivatives. And the latter three have their own exchanges on which they're traded. This is strictly for stocks. So a stock exchange is essentially an auction which is in constant motion. Sellers offer to sell at a certain price, which is referred to as the ask price, and buyers offer to buy at a certain price called the bid price, and the difference is called the spread. In North America, there are four big stock exchanges: the New York Stock Exchange, NYSE, the NASDAQ, the AMEX or American Exchange, and the TSX in Toronto, Canada. The initial concept of a stock exchange originated in 1602 in Amsterdam as we know it today. It was founded in order to deal with the infamous tulip mania, which was the craze going on at the time in the Netherlands. Its function back then was primarily to settle price wars for these tulips. The first publicly listed company was on the Amsterdam Stock Exchange and was called the Dutch East India Company. This was the first initial public offering, IPO, as we know it today. An IPO is the first public offering a company has after it is granted permission to become listed on the exchange. Becoming exchange listed requires some special requirements to be met. For example, the New York Stock Exchange requires a company to hold stock worth more than $100 million and have issued at least 1 million shares, all the while having earned above $10 million the past 3 years. On the flip side, once a company's stock price falls below a threshold or the listing requirements are no longer met by the company, action will be initiated by the exchange to delist the company from the exchange, and this is simply removing it. Often delisting occurs when there's a merger or acquisition by a larger company, usually in the same sector as the company itself. Before the internet age, it was quite a task to purchase shares of a publicly listed company. So before the internet age, or 1990 and before, a trader or investor had to call their broker or the exchange to place a buy or sell order instead of being able to do it online. And prior to this, when there was no telephone, one would need to bring a paper slip to the stock exchange to place a buy or sell order, usually requiring a long trip if someone lived across the country. So as you can see, we've changed a lot in the last while in this regard. So we can also tie this back to the concepts of our economics lecture. Exchanges allow sale of assets, which fluctuates the available quantity and raises and lowers the price accordingly. And this price movement, as we've seen, is governed by the laws of supply and demand. Any company, big or small, that does not meet the requirements to be listed on an exchange is traded on the over-the-counter or OTC market. Stock exchanges serve to provide liquidity for shareholders that trade on these listed stocks, and that often is an issue for the OTC market. So exchanges exist to serve various roles and purposes in the economy. The first is for raising capital. Issuing stock allows investors and traders to buy a part of a company, which serves as funds to grow and innovate. And this is also in the best interest of the company as well. The second is redirection of funds. An IPO can allow savings to become investment funds by the sale of common stock, which aids to grow the whole economy through innovation. Again, allowing funds for these companies. The third is profit sharing. And this is the ability of average households to access the internet and their broker to buy stock and participate in profits and growth of a company through its price appreciation and dividends over time. And I'll do a future video on dividends as well. And the last is corporate governance. So the pricing of a public company becomes transparent when it's listed, and good corporate management is in both the best interest of the company and the shareholder. And in this way, buyers are able to make informed decisions, and the company's and shareholders' best interests are at heart. Having stock exchanges as a stock market intermediary is beneficial to both companies and shareholders. So I'll see you guys next week.